Well, good morning and welcome to Reverse Mortgage Weekly, your weekly guide to reverse mortgage loans here. My name is Zach Smith. I own Chariot Financial. I'm coming to you live and direct from Chariot Financial's offices here in Lakewood, Colorado. So thank you all of those who are joining me. Again, this is something I do every week. Just show up, put a camera on and start talking about reverse mortgage. So you can always call me or visit our website. You can reach us at 720-502-3278. If you're seeing the live stream on Facebook, then you've got access to our Facebook page. So please feel free to contact us anytime, or you can reach us at chariotreverse.com. That's a great way to get our contact information as well. So I try to go over different topics each week, just stuff that's rattling around up there, that I'd like to explain to people in regards to reverse mortgage. And this week I wanted to talk about a subject that is really, I'm surprised that not more reverse mortgage people are talking about this and offering these type of programs. So the reverse mortgage loan, it's there's not just one reverse mortgage. There's several different types of reverse mortgage. And depending on how you decide or how you're looking to take funds out or harvest equity, so to speak, from your with your reverse mortgage is going to depend greatly on which program you determine or which program you look at and things like that. So I wanted to dissect two of the different programs right now. There are proprietary programs that are available. The one that is most popular and widely used right now is called the Hecm program. That's HECM, that stands for Home Equity Conversion Mortgage. And that program is based on the FHA guidelines. It is a government-sponsored loan. Some of the differences that you'll find between the Hecm loan and the proprietary products. One, the Hecm loan generally is governed by FHA, so you do have to be 62 to qualify for these programs. On the proprietary programs, they've actually lowered the age to 55 that you'd be able to qualify. Now, there have been some companies that have stopped offering, some banks have stopped offering their proprietary programs. So I don't know how long those are going to be around, to be honest. So it sounds like there's, as you know, in the mortgage industry, it's very tumultuous right now. There's a lot of volatility in the marketplace. There's a lot of skepticism as to the future of our economy, as to inflation, blah, blah, blah. We all hear it every day. You can't escape it, really. But basically, I wanted to go into the two different programs because there's some pretty stark differences between the programs. One being the age. On the Hecm loans, you have to be 62 to qualify. On the proprietary programs, you have to be 55. So it's a great advantage to people who don't want to wait that 7 years. For instance, when I turned 55, I'm running down to the bank to get one of these programs because it's all part of my financial planning, my future, how I want to pass a greater net worth onto my heirs and things of that nature. So the other difference that you're going to see, though, and this is there's a few differences, three main differences. One being the age, two being closing costs. Now, closing costs on a Hecm are pretty steep because you have to pay a 2% mortgage insurance premium for each loan that's done, and that's an FHA guideline. That's actually not a reverse mortgage thing. That's more of an FHA thing. For example, those folks who are doing FHA loans, so people who are a couple of years out of a bankruptcy or have lower credit score or something like that, who are needing to do an FHA loan on a forward mortgage, like first-time home buyers, stuff like that, they're still paying 1.75% upfront mortgage insurance premiums on that loan that they're taking out. So with that being said, it's really, people look at the reverse mortgage, the Hecm loans, and they see that 2% because it's pretty steep. I mean, you got a $500,000 property. I mean, we're talking 10 grand that they're going to roll into the loan amount. Now you don't have to pay it out of pocket, and of course, yes, if your property appreciates more than 2% year over year, then it basically pays for itself. But it's still nonetheless a cost that people look at when they're taking out the reverse mortgage. With the proprietary programs, they actually don't have that charge at all. So the closing costs on the proprietary programs are much, much lower than they would be with an FHA loan. Now, the next difference is probably, in my opinion, it's probably the biggest difference other than the upfront mortgage insurance premium costs. And that's going to be the interest rates. Now, interest rates have gone up on forward mortgages. So the money is getting more expensive to pull out. That's good and bad for reverse mortgage, by the way, especially for the Hecm program. And I know that sounds strange. Why would it be good that the interest rates are going up? Well, with the Hecm program, you have the ability to take out a line of credit, and the growth rate on that line of credit is tied to the interest rate. So if the interest rates are going to go up, and if they continue to go up, well, what do you know? That's actually good for the reverse mortgage line of credit. That means that your growth rate on that, the access that you're going to have to equity on that line of credit is going to continue to grow. So you're going to be able to catch some of that compounding interest. Now, the mortgage note, yes, it's going up as well. So the reverse mortgage, the reverse amortization is still occurring. But the big difference, getting back on track here, between the proprietary programs and the FHA programs is going to be the interest rate. The interest rates are hovering somewhere around the 7s to 8s on the proprietary program. Right now, we're probably in the low to mid 5s on the Hecm loan. So the Hecm loans tend to have a, basically same interest rate that you're going to look at with a forward. The proprietary programs are a much higher interest rate. So what does that mean? So, well, interest rate on a forward mortgage is a big deal, because if that interest rate goes up, you got to come out of pocket for that cash. You got to come out of pocket for that payment. On a reverse mortgage, of course, there's no required monthly payment. Now, there is a monthly payment. I want to be very clear about that. It's not going to eliminate your payment totally. It's not going to do any of that. It basically turns it into an optional payment. So the interest rates are much different compared to the proprietary programs in regards to the Hecm program. So 3 main differences, again, between those programs. 1, age. You're going to need to be 62 to qualify for the FHA programs, and 55 for the proprietary programs. Number 2, the difference between those is the closing costs. Normal closing costs, except on the Hecm, the FHA programs, you pay a 2% upfront mortgage insurance premium, which 2% of the property value. So again, $500,000 appraised value, $10,000 they'll roll into the note. You're not coming out of pocket with that or anything like that, but it is being added onto the note. Thirdly is the interest rate. Interest rates are much lower on the Hecm program as opposed to the other program, the proprietary program. So why would anybody choose a higher rate? Why would anybody choose to do an upfront mortgage insurance premium? Well, my philosophy is with my clients and everyone that I work with is to just give you the facts. I don't want to sugarcoat it for you, just here it is. Here's the full spectrum of what's available. And you can kind of pick and choose what you think is going to be best for your situation. I mentioned before that I'm running down to the bank and going to get a proprietary reverse mortgage when I turn 55. I'm a little bit of ways from that now, but when I do turn 55, that's my plan. That's my goal. I'm running down to the bank to get one. Well, why would I want to choose a proprietary program that has a higher interest rate and things like that? Well, that's not what I'm really looking at. I'm not looking at the negative amortization. I'm looking at the removal of the actual principal and interest payment. That's extremely valuable to me, because then I can take those funds that I'd normally be paying my mortgage payment with and put them into an investment. I can start saving them. But the key is I have access to it now. And I have other investments, in place and things like that. So it's just part of my plan. It's not going to be, the right program for everybody. It's not going to be something that everybody wants to do. But for me personally and my clients, That's their plan. They want to eliminate that, and I got to be careful not completely eliminate the payment, but they want to transfer that payment, convert that payment into a payment optional reverse mortgage. So that way they don't have to crack that nut every single month to come up with that monthly payment. They can basically let their equity pay for that, and have access to more of their equity at the same time. So I've got some information that I prepared for the call here. These go by really quickly. You know, when I first started doing these, I thought, oh my gosh, I'm going to have to really come up with a lot of material, and it's going to be really tough to do these. But quite frankly, there's so much to talk about when it comes to these programs that I don't find it hard to come up with material here. So I wanted to basically come up with, and I'll share my screen here so you can see what I'm looking at, but I wanted to do somewhat of a side-by-side comparison of what we're looking at when it comes to the proprietary programs and the reverse mortgage programs, or the Hecm programs, or the government programs. So this is a sheet that people will get. This is a sheet that people will get when they do a reverse mortgage loan. They will get a basically an estimate here from us, kind of outlining all the different programs. You can see this is a reverse mortgage loan, the company's up here, all that. We've got our borrower, Benjamin Franklin here, you know, a penny saved is a penny earned, you know, well done is better than well said. An investment in knowledge pays the best interest, plethora of quotes from him, and great service to humanity, in my opinion. So we're doing a reverse mortgage for him here. So we've got three programs here that we're comparing. This is a loan comparison. We've got the Hecm. This is a line of credit. It is an adjustable rate loan. This is a Hecm fixed loan. And this is Equity Elite. This is one of our proprietary programs that we originate here at Chariot Financial. So let's just, you know, go right down the line here. We got lender's margin. There's no margin on the fixed here. There is on the line of credit programs. Interest rate, we'll just keep it real simple here. Today, it looks like we're coming in about 4% on a reverse mortgage loan. That's actually much better you can get on a forward mortgage. And that's another misconception about the reverse mortgage, that the interest rates are really high. Well, if you choose a proprietary program, yes, it's going to be a little high here. We're looking at about 7.5%. 5.1 on the Hecm, and of course these are based on today's rates. Rates are a lot like gas prices. They're market driven, and they are determined on the actual market conditions and things like that. So we're just saying this person has a $450,000 home. They have $200,000 that they need to pay off in debt. I don't have his age here. Date of birth, January 1st, 1947. So the reason I point out those three factors is that that's really what we're going to use to determine what we qualify for and what we can offer, is based on those three factors. It's age, value, and debt that we're paying off. Now, $450,000, this is that initial mortgage insurance that I was talking about. It's right there. So in this scenario today, based on what I'm looking at here, they would probably be able to get something put together. This is based on a tenured payment, actually. So they would be getting a payment back or a line of credit of right around $12,000 on a reverse mortgage after paying their $200,000 off. These are, you know, normal closing costs, about $4,000. We usually charge we charge a $2,000 flat rate origination. So we're paying off the debt. So after everything's said and done, total mandatory obligations about $214,000. So the one thing that a lot of our clients like to look at is this amortization schedule. Now, this is based off a 4% appreciation year over year. You know, right now, Colorado, in some places, they're 20% appreciation. I don't feel like that's sustainable, and I'm not going to present something that I don't think is going to be. I'd rather be the hero than the goat when I put these together. You know, yes, your house might appreciate 20%. for the next 10 years, who knows? Or it could drop down to 2%, or it could go negative. I mean, we could have another 2008 event. A meteor could hit the earth tomorrow and all bets are off at that point. So although I would imagine that housing would probably increase if that happened. But the point I'm trying to make is that this is the national average over the last 30 years, 4% appreciation, not the 20% we're seeing right now. This is an amortization schedule. It shows what the loan balance would be, what you'd have access to in regards to the home equity remaining, the net home equity. This has your year, your age, remaining line of credit, cash advance. The reason I wanted to show this to you is that this is really one of the big questions. I want to show the difference between the two programs, firstly. But secondly, I wanted to also just show that this is the kind of things that we go through with our clients when we do a reverse mortgage loan, is we basically will go through all this data tailored specifically to you for free. That's all we, to get a free estimate, it doesn't cost you anything. That's why, I'm a big proponent of, before you're making a big decision, especially in retirement, you want to make sure that you have all the angles covered and that you're looking at things, have all the information you need to make a decision. It's vitally important to make the right decisions in retirement. They equate it to climbing a mountain. When you're climbing the mountain, that's when you're working. When you ascend to the peak, that's when you're finally, okay, I'm ready to retire. Well, those of us who climb mountains and things like that, we know that the most dangerous part of the hike is coming down, because if you slip, you can fall much faster. And the same thing with retirement. When you're descending, when you're in retirement, it's vitally important that you make the right decisions, because you can fall much faster. So based on this program, on the proprietary program, yes, the interest rate's higher. The closing costs are going to be lower because you don't have that mortgage insurance premium, but they're offering access to a lot more equity on these programs. Look at this. You're going to be looking at roughly $47,000 in a line of credit. The other program's offering about $12,000. So, you ask some might ask the question, why would you pick a higher interest rate? It doesn't make any sense. And in some cases, I would say, yeah, you're right. It doesn't make sense. If you're going to be in the property long term, the longer you're in the property, you want that interest rate to be as low as possible, because you're going to be experiencing negative amortization, compounding interest working in reverse. So you want the lowest interest rate that you can if you're going to be in the house for the rest of your life. If you're going to be in the house another 4 or 5 years or something like that, the other program may be a good option. Or if you need access to cash, or if your HOA is not FHA qualified. Those are all reasons that people are choosing to look at these other programs. So anyways, I hope you enjoyed my little presentation today. I didn't get through everything that I wanted to get through, but if you have any questions for me, you can always visit us at chariotreverse.com, or you can give me a call. Pick up the phone or the rotor dial, or come on and visit. We're in Lakewood. You can reach me at 720-502-3278. Thank you so much for your time, and I hope you have a great rest of your day.